So welcome back friends. How many of you know that recently SEBI has actually decreased margins for all the brokers? And that is a very good news for all the retail traders, because now if you trade in futures and options and if you trade your positions with hedging, the margin required is drastically lower. And I have seen in some cases, even if you compare to the past, the margin required in a hedged position is almost half or even more than that. So in this video, I am going to show you what are the new margin implications after SEBI has launched their new margin rules in this June 2020. But before I go deep into the margins launched by SEBI, you have seen two columns in any broker's margin calculator. One is span margin and another is exposure margin. And after calculating both the span margin and exposure margin, the total margin is shown. So first let me show you what are the span margin and what are the exposure margin. So let me directly take you to Zerodha's margin calculator page. But before that, let me give you a short intro of mine. Hello friends, I am Indrajit from stockmaniacs.net. If you want to grow your wealth from the stock and commodity markets, hit the subscribe button and hit the bell notification icon. You can also send me your stock market related queries through WhatsApp in my number +91 96743 21856. So my dear friends, this is Zerodha's margin calculator page, and by default if you open their margin calculator page, you are onto the FO margin page. There is future and options margin on this FO margin calculator. Then there is equity futures margin tables, commodity margin tables, currency and equity, that means cash. So first let us discuss what are the new rules that has been implemented by SEBI on the future and options front. And this margin, whatever is reduced by SEBI, this is due to the hedged positions. So I'll also show you how you can hedge your positions in any broker. So I believe that you already are having an account in Zerodha. If you do not have an account, I'll give you the link to join Zerodha in the video description. So from there you can join Zerodha, you can open their account and you can come straight to their margin calculator page and you can check the new margins implemented by Zerodha. So let me show you the new margins. First, the exchange is Nifty future and options. Then the product is futures. Let us keep futures. The symbol, suppose let me take Nifty. So Nifty 25 June 20. And net quantity, the lot size is 75. Suppose we will keep as buy. Let us add. So my dear friends, you can see by default the span margin is 1,27,071. Now what is the meaning of span margin? So span margin is the bare minimum margin that is required by the exchange. So this is the first component in any margin calculator. Next, there is another set, that is exposure margin. So you have seen the span margin is 1,27,071 and the exposure margin is 15,218. Now what is exposure margin? This is basically in the discretionary of the broker. So this is broker specific. Broker to broker, this exposure margin can vary. So Zerodha here is charging 15,218 over and above this span margin. Some other brokers can charge different, but Zerodha is charging rupees 15,218. So total margin, if you calculate, that is the span margin plus exposure margin, that is now coming to rupees 1,42,289. So this is if you want to buy one lot of Nifty future in the current market price, this is the total margin you need to pay if you want to carry the Nifty future position. Now Let me show you. If you just sell a call along with this Nifty futures buy position, the margin required will be drastically lower. And you know that even selling call requires margin. But if you combine both of them, the total margin can come down. Suppose now we will sell a call, we will add options and symbol we will keep it Nifty and call type options and strike price. Suppose strike price is 10,200. Currently the market is around 10,150. So we will take a call of 10,200 and we will actually sell the call. Now we will add to the position. You can see, my dear friends, for Nifty future buy position, the total margin required was 1,42,289. And for selling one lot of Nifty call option, the total margin required is 1,33,351. So the total margin required was supposed to be 2,75,641. But as this is a hedged position, the total margin required is drastically lowered to 1,57,503. So in this margin, you can buy one lot of Nifty future and you can short sell one lot of Nifty call. So you are getting a total margin benefit of rupees 1,18,138. Now I'll show you, instead of shorting a call, if you buy a put, what is the margin benefit? So now the market is around 10,150. So I'll take a put and I'll buy that put and I'll take a strike price of 10,100. I'll add. So you can see, my dear friends, the margin is now drastically being lowered. We required rupees 1,42,289 margin for buying one lot of Nifty future. But just if we buy one lot Nifty put option, that is actually hedging our position, you can carry forward one lot of Nifty future with one lot of Nifty put option, just a total margin of rupees 27,533. So that is a margin benefit of 1,14,757. That is huge. So you can understand, you can buy one lot of Nifty future and simultaneously if you buy one put, it will hedge your position and you can actually carry forward your buy just at rupees 27,533. That is the benefit that SEBI is giving for all the retail traders nowadays. So now, my dear friends, let me clear these positions. So now we will check if we sell one call and if we buy one call. So suppose we are taking Nifty 30 July 20. So we will short sell a call of 30 July. Suppose the strike price is 10,500. So we will short selling a 10,500 call option of 30th July. So net quantity is 75 and the position is sell. We will add. You can see, my dear friends, if we nakedly sell one call option of July month, the total margin required is 1,23,429. But what we can do, we can hedge this position. Let me check what is the price of this 10,500 July call option. So this is Zerodha Kite. Once again, if you do not have Zerodha Kite, you can get Zerodha Kite by clicking the link of Zerodha joining in the video description. So I'll give you the link to join Zerodha in the video description. So from there you can join Zerodha and you can get Zerodha Kite instantly. So I'll add the Nifty July 10,500 call option. You can see, my dear friends, this call 10,500 call you can get at 240 rupees. So if you sell this call, you are getting 240 rupees as a premium. So to hedge your position, as the price is 240, I'll show you what is your break even. Let me check where is my break even. So we are selling a 10,500 call option and we are getting a premium of 240. So we are getting a premium of 240. So till Nifty crosses 10,740, my position is safe. So if Nifty crosses 10,740, I will face unlimited loss in this call selling. So my dear friends, in this case, we can hedge our position by buying a 10,700 call option simultaneously. Suppose instead of July month, we will buy the 10,700 call of this month. So let us add Nifty June 10,700. So 10,700 CE, you can see this is available at 61 rupees. So whenever we are selling the 10,500 July call, we are getting a premium of 240 rupees, and if we buy a Nifty June 10,700 call, we are paying a premium of 61 rupees. So still we are having 180 rupees net premium. So let me find out what is the margin implication now. So let me go back to the Zerodha margin calculator and let us add 10,700 and June series call. Instead of selling, we will be buying. Click on add. So my dear friends, you can see previously the margin required to short sell one Nifty July 10,500 call option was 1,23,429. So once we hedge the position by buying one Nifty June 10,700 call, you can see the margin required is drastically lower. The margin required is now come to rupees 43,024 and we are getting a margin benefit of more than 80,000. So this is the new SEBI rule, how you can be benefited by using this new SEBI margin rule of June 2020. Similarly, my dear friends, instead of Nifty or Bank Nifty, if you trade on say any stocks, suppose you trade on SBI. So SBI in June 20. So instead of options, let us now go to futures. First, let me delete all the positions. So SBI in futures, the net quantity lot size is 3000 and we will be buying. First, let us check what is the price of SBI. So here I'll add SBIN and you can see the current price is 187.80. So let me go back to the margin calculator. So we are actually buying one SBIN future. Let us add. So the total margin, you can see the span margin, the margin required by exchange, that is 1,71,180, and the exposure margin is rupees 19,782. This is charged by Zerodha. So the total margin required is rupees 1,90,962. So that is huge. A normal trader cannot pay this margin. A small trader will not be able to pay this much of margin. So we can hedge our position. Suppose now the SBI price is 187.80. So we can buy suppose a 180 put option of SBI. So go to options. Let us check first what is the price of the put option. So SBIN June 180 PE. You can see the put is available at 6 rupees. So option, and here it is 180 and the option type is put. So we will add. You can see, my dear friends, we have bought SBI futures. So the total margin required was 1,90,962 And if we buy a put option, if we hedge the position, so the total margin is coming to 19,782. So previously it was 1,90,000 and now it is 19,000. So it is just 1/10 of the total margin required. So if you hedge the position, you are getting a margin benefit of rupees 1,71,180. So that is huge. So my dear friends, I have shown you, if you just hedge your position, if you buy a future, if you simultaneously buy one lot of put, the margin required is drastically lower. Similarly, if you short sell a future and simultaneously if you buy a call option, it can once again drastically reduce the margin required. If you short sell a call and simultaneously you buy a call, it will also reduce the margin required. So this is the new rule that SEBI has made, and I am extremely happy to announce this in front of you, because all my small traders, all the small traders who are subscribed to my channel, they will be immensely benefited. So if you are now having less margin also, you can safely take home a future by just hedging with a option. So this is how you can trade from now on, and this margin reduced can change the whole ball game a lot. Many new traders, many small traders can be attracted to the stock market, and they can safely trade the futures and options just by hedging their positions. So if you have any query regarding this, you can simply shoot a comment below this video. I'll be happy to answer your comments regarding the new margin implications of SEBI. So friends, I have completed today's webinar. If you like today's video, please do not forget to hit the like button. Please also do not forget to share it with your friends, because if you share it, someone else can also be benefited. If you have any queries, just ask me in the comments. I'll try to answer you as early as possible. Friends, thanks a lot for watching this webinar till the end. Bye bye.